All right. So is everybody back?
Yeah, I'm here.
Anna, are you there?
Yeah.
Okay, cool. Yeah, I thought I heard you. Just want to make sure. All right. So if everybody's good to go, we can continue with futures. Um, we're almost done with this module, so hopefully we can start technicals. But I really want this material, to go over this thoroughly because this is really what we're going to be trading. And by we, I mean like me and Chen. We advocate futures for the reasons you'll see here. So what is a futures contract? A futures contract is a legal obligation between a buyer and a seller to deliver an underlying asset on a specific date at a specific price. Okay, so we have a thing that we're agreeing that we're focusing on, and we're agreeing that at a specific date we're going to deliver that at a specific price. That's the fundamentals of what a futures contract is. Of course, we could cash settle. We discussed about that before. Remember, just when we were discussing oil, just because you trade oil doesn't mean you want 1,000 barrels of oil showing up at your doorstep, right? So you're going to cash settle that contract, but the understanding of what that thing is, and how it, how the contract evolved is very important. Okay, so futures contract can be created for all tradable commodities, oil, FX, that's forex, indexes. Okay, remember in the previous slide we were discussing the indexes and how they're not actual things, right? They're just numbers. However, that we can have ETFs or futures contracts or options or whatever that track them, that act like them. So when you want to say buy the S&P, you don't actually buy the S&P. You buy something like, in this case, a futures contract that tracks it. Okay. Now there's also other things like government bonds, even cryptocurrencies, right? So uh, Bitcoin futures that came out last year. Okay, it's a very, very new thing, but we try to stay update with the times in our modules here, and the CME does as well with the products that it offers. So it was a big fight to get Bitcoin futures listed on a major index, but finally it was. So when you say that you trade a particular thing, a lot of times you say what you really mean is that you trade futures contracts on that thing. So my favorite thing to trade is bonds. Do I actually buy 30-year government bonds and hold them and go to a seller? No, I don't. Okay, when I say that I trade bonds, what I really mean is that I trade futures contracts on bonds. Okay, when I tell you I trade stocks, that's what I mean, is that I'm actually trading the futures contract on the S&P. Okay, when I tell you I trade oil and so on, that's what I mean. Stocks and futures trade on different exchanges and have different regulatory bodies. This is very important, right? Futures trading, because they're different things, right? With futures, the regulatory, sorry, with stocks, the regulatory body that concerns that is the SEC, right? The CFTC is the regulatory body that is concerned with futures, okay? Because again, they're very different things. So futures trading is highly leveraged, where stock trading is not. This is a very important thing to understand when you're choosing what to trade, right? Because remember, when I was discussing the advantages and disadvantages of stock trading, typically stock trading is not leveraged, right? So when you open up an account with a broker and you want to trade stocks, you have to actually buy those 100 shares of Apple. Okay, and then you have to actually sell them. And if you do that regularly, you have to have $25,000 in the account, and that's a federal law, okay, in the US. Whereas futures trading, you put up an amount, right, and that amount varies by the broker. And depending on the contract you want to trade, there is a margin requirement behind that. So, for example, the riskier products are going to require that you put up more money than non-risky assets, right? So for example, bonds are usually the lowest bar. That's why I advocate people to start trading in bonds for many reasons. We'll get into why. That's just one of them, right? So with less amount of money, I can buy more contracts. right? With a riskier, more volatile product, these exchanges, sorry, the brokers aren't stupid, right? They understand the fact that riskier assets, are going to be more vicarious, right? So they require you to put up more money in order to trade those things. Okay, so futures contracts state the quality and the quantity to be traded on. Contract specification, we discussed about that earlier. So when I trade the S&P 500, I have to understand that's in the symbol itself, right? It'll be, it'll be, for example, it'll be ES H20 or something like that. The H specifies the month, and the 20 is the year. The ES is the root, right? So that tells you, we'll go over many examples of this. You don't have to digest this now, but just understand that in the contract symbol, it specifies all those things. Okay, now when I trade, if you want to get into a particular thing, you understand that if you trade oil, well, it's not just oil that you can trade, right? CL is typically the symbol for oil, but you could also trade gas, and there's different grades. Like gasoline, that's the symbol, I believe, is RB. And you have different grades of fuel that you could trade. Okay, the most common one being CL, that's crude oil, but you have to understand that there's many classifications of things within a broad product, right? So when I say oil, I'm talking about crude oil, that's just understood, but there's other things that you could delve into as well. Many futures contracts trade, most futures contracts trade through regulated exchanges. And really the ones that we're going to point you to are going to be properly traded through large exchanges. The biggest one being the CME, or the Chicago Mercantile Exchange. But we also have the Chicago Board of Trade, and that was the first established exchange in the US. Now, this is really one of the reasons I like trading futures. Is I find the history very interesting, and it began with agriculture. And there's a reason why the Chicago is really the center of trading derivatives in general, futures being one of them. When I say futures or options, those are a form of derivative. We call it a derivative because it's not the actual thing. It's a contract that tracks that thing. Does that make sense? So yeah. when I buy a futures contract on bonds, again, I'm not actually going to the U.S. Treasury. Hey, can I get this? No, I'm trading a contract that tracks that thing, right? So this is very, very important in the development of this financial asset. Or this securities classification. And this is one of the reasons why Montreal is kind of like the Chicago of Canada, because there's a lot of trade intersections by just the fact that we're on a bay here and everything. There was a lot of there's a lot of granaries. To this day, if you go to the Old Port, you see the relic. It's like this post-apocalyptic looking thing. It's kind of an eyesore, but they keep it there for historical purposes because it was a granary. Right. So, in Montreal, this is one of the things that kind of evolved, just like in Chicago, where Chicago was kind of a big trade center between, the East and the West of the United States. So you'd have a lot of people coming there, farmers who was like, look, if I'm a farmer and it costs me $8 a bushel to produce a bushel of whatever, right? That means I'm happy if the market conditions bring me up to, say, $10. That means I've made money, okay? Now, if the market conditions saw to it that, a bunch of people are producing this thing, or there's bumper crops this year, and the market price is now $6, well, that means I'm fucked, right? So what basically happened was you'd have a banker or a finance guy like me who says, look, I will give you a contract to buy this crop at $10, okay? So that means anything above $10, I pocket. So if it goes up to $15, well, hey, I mean, you're just left holding the sack that I gave you, that $10, but I'm happy. However, I take on the risk that it's going to go to $6, and I'm stuck having to pay this dude that extra amount. So that's kind of like the history of how this entered and why geographically Montreal is very similar to Chicago in that financial sense, whereas Toronto is very similar to New York in just from that perspective, because there's a lot of companies are centered there. The stock exchange is there. A lot of companies are centered there, so a lot of interactions with stocks take place via New York, and Toronto. So I like to say Toronto is like the New York of Canada. Montreal is like the Chicago of Canada, at least from a financial perspective.